It's a countdown to chaos. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's an urgent alert as global markets face a major shock in just 7 days. This is coming next Tuesday with the markets reopening after the Memorial holiday. It's already sending traders into panic mode. I'll show you why they're expecting all-out chaos to begin Tuesday morning. And that's not the only problems facing the global economy. Another U.S. retailer is flagging big problems with U.S. consumers as another major trading partner is seeing problems at home. Now let's head over to Bloomberg, where he picked today's story up with a headline: as speedier Wall Street trades are putting the global finance on edge, putting panic in the hearts of traders all over Wall Street. And when U.S. markets reopen next Tuesday after the long weekend, everything will likely seem normal. It's only after the close in the following days that any cracks are expected to appear, and many are expecting a lot. A spike in the number of failed trades or operational glitches and additional costs are among industry fears as the trading process for American securities accelerates, with the time allowed to complete every transaction halved, now down to a single day. And this is a huge problem because we're going to likely see more failed trades. This is going to cause dealers to need to hold more collateral. This could force people to sell securities to create cash that they just don't want to sell. And when you start seeing a lot of failed trades, well, that means volatility is going to pick up, but in an unexpected part of the markets. And it all faces an immediate stress test as some of the world's major indices rebalance or reveal plans reconstitutions before the end of this month. And all hands will be on deck. This according to Citigroup's global head of custody data for security services, noting the likelihood of increased trade fails across the industry. There will be significant uptick in settlement risk for the first several weeks. And where you see this is people sell something, turn around and buy something, and what they note is they don't get cleared on the original trade, so they don't have cash. They start to get hit on the margin side. They get margin called, and next thing you know, they're being forced to liquidate other positions or put cash in their account, and all of a sudden everything changes. But imagine this: when you're rebalancing billions of dollars in one move, well, it's going to cause problems across the board. And JP Morgan Chase internal modeling shows about a quarter of the currency trades and processes for clients are set to be impacted. And this is going to be a severe issue as it is, because we're seeing problems in the currency markets today. We're seeing weakness in the yuan and the yen, and the dollar is getting stronger. And what this could do is cause even bigger dislocations, could trigger some major moves in the currency market, and that would be very dangerous. Brown Brothers and Harriman is putting clients through a T+1 simulator to try to even identify these potential issues. But as we know, simulators are not going to be the real deal, and we're going to find out just how good the system is. But many insiders are saying it's not ready. And just 9% of the sell-side firms polled by the coalition Greenwich in April and May said they expect the T1 switch to go smoothly, with 38% warning that buy-side managers are not prepared, and 28% believing trading platforms they're not ready either. Almost a fifth anticipate that's 20%, a large disruption with many or severe issues. And what this is going to lead to is an increase in volatility in the markets. And when you start to have volatility reappear, things start to move in a big way. And particularly when you see machines start to move based on a price change, next thing you know, you can have a lot of selling, a lot of liquidity issues, and a lot of failed trades. But one thing you can turn to your friend and say, hey, look at this. I made a ton of money on wheat, because if you ever seen a headline like this, wheat gains as dry weather in Russia exacerbates crop concerns, and said, man, I wish I could make money. I wish I could have bought this before it took off. Well, we showed our subscribers how to buy down here. And how do we do that? Well, we look at the machine positioning every day, and we run a historical overlay. You want to beat the machines. You want to buy before they come out of their deep short positions. We show you those opportunities. Had you followed that report, you'd be up 23.88% as the close of business yesterday, and price rallying today. Maybe you're a technical trader and you find yourself bouncing all over the place with those technical signals. We smooth them out. We aggregate them together, run a proprietary overlay. We call that that Momentum Timer Pro, look at the same thing. We showed you when to buy this. We showed you how to make money. It's just that simple. We even put out videos, and here's the best part. You get 30 days for free. Check out the links in the description below. Start making money before the headlines hit. And the $7.5 trillion today foreign exchange market is a flashpoint of the shift because currency trades typically settle on a T+2 basis. And overseas investor buying a U.S. stock will soon need to either have dollars ready or find them within a day under our arena where it can take two. And that's a problem because what are we seeing right now? A major dollar shortage, and price of dollar goes higher, makes them costlier to get. And next thing you know, you're going to have chaos hitting the markets. We'll find out Tuesday evening, and who knows where it's going to be after that, because the Foreign Exchange Professionals Association reckons the problem will also be acute at month and quarter ends around national holidays. Well, think of Memorial Day, risking significantly increased volatility and wider spreads. There's 25 to 30 days a year where there's potentially specific challenges and specific holidays on a global basis, and this is going to, again, lead to liquidity issues. In fact, the European Fund and Asset Management Association estimate as much as 70 billion of its members' daily currency trades may miss the CLS deadline for next day settlement. This is going to, again, cause nothing but chaos in the markets, could lead to some big currency moves, cause some major headaches with the market. But now let's turn to the U.S., where another retailer is flagging big problems with the U.S. consumer. As Lowe's now sales beat estimates, but key here word is estimates, with boost from pro contractors, but that was about the only beat they had. Inflation and high interest rates have hurt consumers' appetites for big purchases, eroding sales at Lowe's and its main rival Home Depot. But even as consumers have held off on renovating and remodeling homes after rushing to do so during the pandemic, and you think about why during the pandemic, they had two important things. They had time because they were off work. Number two, they had money due to all the stimulus. That was a big factor, and both of those are now gone. Professional contractors remain a valuable source of revenue that Lowe's has increasingly sought to win over, and the company posted profit down about 6%. That is staggering compared to last year, but still ahead of estimates. That's the key word, estimates. And Lowe's notably projected a decline of 2 to 3% for comparable sales for the period. Well, they beat that too, to the wrong direction, down about 4.1%. And this is only going to get worse at a time when investors are really believing that companies are going to drive outsized profits going forward. We'll show you why it's not likely to happen at all. As we see corporate profits after tax here in blue against average hourly earnings of production and non-supervisory employees, multiplied by the average number of weekly hours they work, and what's called total compensation. And when consumers have less money to spend because their total compensation growth is slowing, here you can see as that red line shown on a year-over-year rate change slows down, what happens to profits is they usually go down with it. And it makes perfect sense because as consumers have less money in their pockets, they spend less, and that hits the market. But I want you to note here, there's a big dislocation. Investors are saying, no, look, profits are going to go through the roof and take the stock market higher. And consumers are saying, wait a minute, I don't have the money. And even Home Depot posted negative quarterly sales results last week, citing large weakness in discretionary products. We noted the same with Walmart and McDonald's and Target. And we're hearing more and more about how the consumer is stressed and out of money, and that is all translating now to the commodities market, as we're seeing with this headline. As oil declines, as key trader gauges point to market weakness, and this is surprising because what do we continue to hear out of OPEC Plus is they need to continue to constrict supply to drive prices higher, and yet something strange is happening. Price continues to fall. And here we can see Brent futures remain about 7% higher, which does feed into, of course, consumer price indices all over the world. And traders are turning their attention to the producers group meeting in early June, where rollover existing curbs is largely expected. And there's no surprise they have to continue to do this. The problem here is OPEC's budgets, they need high oil prices. The problem is the markets are saying no, and for a big reason. Consumers, well, they just don't have the money. There's too much supply looking for a home, something that's on clear display through the continued weakness in time spreads. More likely, you can just look at consumers' total income and realize that they just have less money. And I want you to be thinking, if OPEC Plus did not curb, of course, supply, just how low would oil be? Where would inflation be? You can almost look right overseas to wonder why inflation's still where it's at. And here you can see the consumer price index against U.S. regular all formations gas price. That's shown in red. And what we can see is gas prices on a year-over-year rate of change are about flat. And if that continues to head down as demand declines, well, it's going to bring inflation with it in a big, big way. And here we can see Korean consumers turn pessimistic as we now look to other parts of the world as rates stay higher for longer, and that's the expectation, and that's leading to a drop in consumer confidence. Of course, the real drop in consumer confidence, well, I'll show you what that is in a moment, as the composite sentiment index slumped in May to 98.4, falling below the threshold of 100 that divides optimism and pessimism for the first time since December. It also marked the biggest drop since September of 2023. And what would drive that? Well, is lack of prosperity. Here you can see, looking at U.S. data, we have the University of Michigan Consumer Sentiment Survey shown in blue against total compensation in red. And what do you know? When consumers have less money, and this is not surprising, their confidence goes down because their ability to spend and enjoy life declines. This is one of those weird times where you're seeing confidence in the data rise against a decline in total compensation, only suggesting that at some point American consumers are going to change their view about the economy in a big way, that this is going to show up in the survey data. And what's really key here is when you see, of course, confidence go down, what happens to spending? Well, it's also a function of compensation. If you don't have the money to spend, you can't spend it, but spending starts to go down, and that's what's happening exactly in South Korea as early trade data shows export momentum rising. And this is largely probably a function of the strong dollar and weaker currencies against the dollar. We should likely see increased exports from other parts of the world, but it's underneath that data, which is what we're interested in. As the value of shipments adjusted for working day differences increased a massive 17.7% from a year earlier in the first 20 days of May. But look at this, unadjusted exports rose 1.5%. But here's the key. You look at that consumer confidence data, overall imports decreased by 9.8%. Resulting in a trade shortfall of $304 million, suggesting the South Koreans are not consuming because their internal economy, their domestic economy, is starting to shrink, and it's only now maybe being held up on exports. But will that last? Well, if we look at imports into the U.S., of course, the biggest consuming nation in the world, against total compensation growth shown in red, what we can see is while these exports may increase in other parts of the world due to a strong dollar, what we can tell you is domestic consumption here in the U.S. is likely to continue to fall. And what we're seeing now is all the signs that point to heading into recession. I mean, we're in the early stages now and likely to be at one by the end of the year. But if you ask the Fed, they say everything, well, is rosy. As Fed's Waller needs several more months of good inflation data to cut rates, suggesting he thinks everything's great because he's looking at the labor market, which he doesn't realize is the last shoe to drop. Is with the labor market as strong as it is, my focus remains bringing inflation down. Well, if you see, of course, consumption falling, confidence falling, incomes falling, well, what that means is next thing you know, employers are going to start increasing layoffs in a big way. They're already cutting hours, but when you start to factor market chaos, a lack of liquidity, and a slowing economy, the only question just is, why are traders panicking? Well, for good reason. They know something big is coming, and it's going to start Tuesday night. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.